What's the fastest way to fail as a beginner investor? It's not picking the wrong stock. It's not buying at the wrong time. It's investing before you're financially stable. Lesson number 1 from How to Invest $50 $5,000 is simple, but most beginners ignore it. Build your safety net before you try to grow your money. Here's the reality. If you invest your last $1,000 into the market and your car breaks down next week, what happens? You sell your investments, maybe at a loss, maybe during a downturn, and now you've locked in that loss, not because you made a bad investment, but because you didn't have a backup plan. That's why Nancy Dunan emphasizes protection first. Before you buy stocks, before you open a brokerage account, before you think about returns, you need a financial cushion. This is what we call an emergency fund. The purpose isn't growth, it's stability. It's there for unexpected expenses, medical bills, job loss, urgent repairs. Without it, every investment becomes fragile because life can force you to liquidate at the worst possible time. So how much should you have? A practical target is at least 3 months of essential living expenses, rent or mortgage, utilities, food, insurance, minimum debt payments, not lifestyle spending, just survival expenses. If that number feels overwhelming, start smaller. Build your first $500, then $1,000, then keep stacking until you reach that 3-month goal. Now let's talk about where this money goes. Not in stocks, not in crypto, not in anything volatile. This money belongs in a high-yield savings account or an FDIC-insured money market account. It needs to be safe, liquid, and accessible within days, not weeks. You are not trying to maximize returns here. You are buying peace of mind, and peace of mind has a return. Because once your emergency fund is built, something powerful happens. You can invest without fear. Market drops, you don't panic. Unexpected expense, you don't sell. Job uncertainty, you stay invested. That stability allows compounding to actually work. Most beginner mistakes don't come from lack of intelligence. They come from pressure. Financial pressure creates emotional decisions. Emotional decisions destroy long-term returns. Building a safety net removes that pressure. Think of it this way. Your emergency fund is not separate from investing. It makes investing possible. If you're starting with $50, $500, or even $5,000, this is your first move. Secure your base. Create stability, then grow. Wealth isn't built by taking reckless risks. It's built by stacking smart, controlled decisions in the right order. And step 1 is simple. Protect your downside before you chase your upside. If this helped you rethink how you're starting your investing journey, stay with me. In the next lesson, we'll talk about how to use employer benefits to generate an immediate, risk-free return on your money. What if I told you there's an investment that gives you a 100% return immediately, guaranteed? No hype, no market timing, no risk. It's called your 401k employer match. Lesson number 2 from How to Invest $50 $5,000 is this. If your employer offers a 401k match, you take it. Every single time. Here's why this matters. A 401k is a retirement account sponsored by your employer. You contribute a percentage of your paycheck before taxes, and that money gets invested for long-term growth. But here's the key. Many employers match part of what you contribute. For example, if your company offers a 100% match up to 4% of your salary, and you earn $50,000 a year, that means you contribute $2,000. They add another $2,000. That's an instant 100% return on your money. There's no stock, no bond, no real estate deal that guarantees that kind of return upfront. And yet, millions of Americans don't contribute enough to get the full match. That's like walking away from free money. Now let's talk about why this fits perfectly with beginner investing. First, contributions are automatic. The money is taken directly from your paycheck before you even see it. That removes emotion. No debating, no hesitation. It builds discipline without willpower. Second, the account grows tax-deferred. You don't pay taxes on gains each year. That allows compounding to work faster over time. Third, many plans offer diversified investment options like index funds or target date funds. You don't need to pick individual stocks. You just choose a diversified option aligned with your retirement timeline. Now, a quick note about vesting. Some employers require you to stay with the company for a certain period before their matching contributions fully belong to you. This is called a vesting schedule. Always check your plan details so you understand the timeline. Here's the simple action plan. Step 1. Contact your HR department or log into your benefits portal. Step 2. Find out your employer's match formula. Step 3. Increase your contribution to at least the percentage required to get the full match. If you can't afford to do it immediately, increase it gradually, even 1% at a time. Remember, this isn't about investing aggressively, it's about capturing guaranteed value. In personal finance, the order of operations matters. Emergency fund first, then employer match, then everything else. Because investing isn't about being clever, it's about not missing obvious opportunities. If your company offers a 401k match and you're not taking it, you're leaving part of your compensation on the table. And wealth isn't built by chasing risky opportunities. It's built by taking the smart ones first. In the next lesson, we'll talk about how to use tax-advantaged accounts like IRAs to accelerate long-term growth even further. If you want to build wealth faster without taking more risk, here's the question you should ask. Are you using the tax advantages available to you? Lesson number 3 from How to Invest $50 $5,000 is simple but powerful. Prioritize tax-advantaged accounts like IRAs before investing in regular taxable accounts. Most beginner investors focus on returns. They ask, what stock should I buy? But smart investors ask a different question. How much of my return am I keeping after taxes? Because taxes quietly reduce your growth every single year. Let's break this down. When you invest in a regular brokerage account, you may owe taxes on dividends, interest, and capital gains. Even if you don't withdraw the money, you might still owe taxes annually. That slows down compounding. Now compare that to an IRA, individual retirement account. With a traditional IRA, your money grows tax deferred. You may even get a tax deduction today. You don't pay taxes on gains each year. You only pay taxes when you withdraw in retirement. With a Roth IRA, you contribute after-tax dollars, but your money grows tax-free, and qualified withdrawals in retirement are completely tax-free. In both cases, your investments compound without yearly tax drag, and over 20 or 30 years, that difference is massive. Here's a simple example. If you invest $5,000 per year and earn 7% annually, the difference between taxable growth and tax-advantaged growth could mean tens of thousands of dollars more in your pocket over time. Not because you picked better investments, but because you used the right account. This is what Nancy Dunn emphasizes. The account type matters just as much as the investment itself. Now let's make this practical. Step 1. If you have earned income and don't already have an IRA, open one. You can do this easily through a major brokerage like Vanguard, Fidelity, or Schwab. Step 2. Decide between traditional and Roth based on your current income and tax situation. If you're early in your career and in a lower tax bracket, Roth often makes sense. If you're in a higher bracket now, traditional may offer more immediate benefit. Step 3. Set up automatic monthly contributions. Even $100 per month builds momentum. Step 4. Invest the money inside the IRA. Don't leave it sitting in cash. Choose a low-cost index fund or diversified fund aligned with your long-term goals. Remember, an IRA is not an investment. It's a container. What you put inside determines your growth. The key takeaway is this. Before you open a taxable brokerage account, make sure you're fully using your tax-advantaged space. Because building wealth isn't just about earning returns. It's about keeping them. In the next lesson, we'll talk about why diversification, especially through index funds, protects beginners from costly mistakes while still allowing long-term growth. If you only have a few hundred or a few $1,000s to invest, what's the fastest way to destroy it? Put it all into one stock. Lesson number 4 from How to Invest $50 $5,000 is this. Diversify early and don't bet everything on a single company. Beginner investors often think concentration creates wealth. They hear stories about someone who bought one stock and got rich. What they don't hear about are the thousands of people who did the same thing. and lost half their money. When your capital is small, mistakes hurt more. If you invest $1,000 into one company and it drops 40%, you now have $600. To recover from that loss, you don't need a 40% gain. You need a 67% gain just to break even. That's the math of concentration risk. Diversification solves this problem. Instead of relying on one company, you spread your money across many. That way, no single failure can wipe you out. This is exactly why Nancy Dunan emphasizes diversified funds, especially for beginners. The easiest way to diversify today is through an index fund or ETF, like one that tracks the S&P 500. With one purchase, you gain exposure to 500 large U.S. companies across multiple industries: technology, healthcare, finance, consumer goods, energy, and more. If one company struggles, others can offset it. You're no longer betting on a single outcome. You're investing in the broader economy. Now, let's be clear. Diversification does not eliminate risk. The market will still rise and fall, but it dramatically reduces the risk of catastrophic loss from one bad decision. And when you're starting small, survival matters more than hitting a home run. Here's how to apply this immediately. Step 1. If you're new and invest in limited funds, avoid picking individual stocks at first. Step 2. Open a brokerage account or use your IRA. Step 3. Choose a low-cost index fund with a broad market focus, something with a low expense ratio and strong long-term history. Step 4. Invest consistently over time instead of trying to time the market. As your portfolio grows and your knowledge increases, you can choose to allocate a small percentage to individual stocks if you want, but your foundation should be diversified. Think of diversification like building a house. You don't start with decoration. You start with structure. A diversified base protects you from avoidable mistakes and keeps you in the game long enough for compounding to work. Wealth building isn't about finding the one perfect stock. It's about owning productive assets broadly, consistently, and patiently. Because the biggest advantage beginner investors have isn't insider knowledge, it's time. And diversification makes sure you don't lose that time to one preventable error. In the next lesson, we'll talk about another silent wealth killer: high fees, and how keeping costs low can dramatically increase your long-term returns. What if I told you the biggest threat to your investment returns isn't the market? It's fees. Lesson number 5 from How to Invest $50 $5,000 is simple, but incredibly powerful. Keep your investment costs as low as possible. Because fees don't look dangerous. They look small, harmless, maybe 1% per year, maybe 1.5%. But over time, that small percentage quietly eats away at your wealth. Let's break this down. Imagine you invest $5,000 per year for 30 years and earn an average 7% return. If your fund charges a 0.10% expense ratio, you keep almost all of that growth. But if your fund charges 1.5%, that difference can cost you tens of thousands of dollars over time. And here's the worst part: fees are guaranteed. The market might go up, the market might go down, but fees are deducted every single year, no matter what. Nancy Dunan emphasizes that for small investors, costs matter even more. When your portfolio is $1, $0 or $5,000, losing 1 to 2% annually is not a minor detail. It's a serious drag on compounding. And compounding is your biggest advantage. So where do these fees show up? Most commonly in mutual funds and managed accounts. You'll see something called an expense ratio. That's the annual percentage the fund charges to manage your money. Actively managed funds often charge 1% or more. Some charge significantly higher. Index funds and ETFs, on the other hand, often charge 0.03% to 0.20%. That difference might not sound dramatic, but over decades it is. Here's your action plan. Step 1. Look up the expense ratio of every fund you currently own. You can find this on your brokerage platform or the fund's website. Step 2. Compare it to similar low-cost index funds. Step 3. If you're paying over 1% annually, and there's no strong reason to justify it, consider switching to a lower-cost alternative. Step 4. Avoid unnecessary trading. Frequent buying and selling can trigger transaction costs and taxes. The goal isn't to eliminate all fees. That's impossible. The goal is to avoid paying for complexity you don't need. Remember, most professional fund managers fail to consistently outperform the market after fees. So paying high costs doesn't guarantee better results. In fact, lower costs are one of the few variables you can control. You can't control market returns. You can't control economic cycles. But you can control what you pay. And in long-term investing, control equals power. Wealth isn't built by finding secret strategies. It's built by protecting what you earn. Low costs, broad diversification, long time horizon. That's how you let compounding work at full strength. In the next lesson, we'll talk about why money should never sit idle and how to make sure every dollar you earn has a clear purpose. Let me ask you something simple. Is your money working or is it waiting? Lesson number 6 from How to Invest $50 $5,000 is this. Don't let your money sit idle without a purpose. A lot of beginners think they're being safe by leaving extra cash in a checking account. It feels secure. It feels available. But here's the hidden problem. Idle money slowly loses value. Inflation quietly reduces purchasing power every single year. If inflation averages 3% and your money earns 0, you're effectively losing 3% annually without seeing it. That's not dramatic. It's slow, invisible, but over time, it matters. Nancy Dunham emphasizes a simple principle. Every dollar should have a job. Some dollars are for safety. Some are for short-term needs. Some are for long-term growth. But no dollar should be unassigned. Let's break this down in practical terms. First, keep only what you need for monthly expenses in your checking account. This is operational money, rent, groceries, bills. Second, your emergency fund should sit in a high-yield savings account or FDIC-insured money market account. It should earn something while remaining accessible. Third, any money you don't plan to use for at least 6 to 12 months should be evaluated for better placement. That could mean a CD if you need guaranteed short-term return, a bond fund for moderate stability, an index fund for long-term growth. The key is alignment. If you're holding $5,000 in checking just in case, but you already have an emergency fund, that money isn't protected, it's stagnating. Now, this doesn't mean you rush into risky investments. Purpose comes first. Ask yourself 3 questions. When will I need this money? What level of risk can I tolerate? What is this money meant to accomplish? Once you answer those, placement becomes clearer. Idle money often comes from indecision. People wait for the perfect time to invest, but perfection doesn't exist. Markets move constantly. Waiting indefinitely is not a strategy. It's avoidance. Another common mistake is emotional parking. After market volatility, investors pull money out and leave it sitting in cash for too long. That often means missing recovery gains. Cash has a role, but excess cash without intention is a drag on long-term wealth. Here's your action step. Open your banking app. Look at your balances. Identify any money that doesn't have a defined purpose. Then assign it one. Even small improvements, moving from 0% to 4% interest, make a difference over time. Wealth building isn't just about earning more. It's about allocating smarter. Money is a tool. Tools should be used, not stored indefinitely. And when every dollar has a clear job, your financial system becomes stronger, more intentional, and more efficient. In the next lesson, we'll talk about why investing consistently beats trying to perfectly time the market every single time. What if I told you that trying to buy at the perfect time is the reason most beginners fail? Lesson number 7 from How to Invest $50 $5,000 is this. Invest consistently instead of trying to time the market. Market timing sounds smart. It feels logical. Buy low, sell high. Wait for dips. Watch the news. Study charts. But here's the problem. No one consistently predicts short-term market movements. Not professional fund managers, not analysts, not financial TV experts. And when beginners try to time the market, they usually do the opposite of what works. They wait too long to invest because prices feel too high. Then the market drops, and they're too scared to buy. Then it recovers, and they feel like they missed it. This cycle repeats. Nancy Dunham emphasizes that small investors don't need perfect timing. They need discipline and consistency. The strategy that solves this is simple. Invest a fixed amount on a regular schedule. This is often called dollar cost averaging. Here's how it works. Let's say you invest $300 every month into a diversified index fund. Some months, the market is high. Your $300 buys fewer shares. Some months, the market is low. Your $300 buys more shares. Over time, your average purchase price balances out. You remove emotion from the equation. And that's powerful, because investing is not a math problem. It's a behavior problem. When you automate your investments, you reduce hesitation. You stop asking, "Is now the right time?" Instead, you follow a system, and systems outperform emotions. Here's why this matters even more for beginners with smaller portfolios. If you wait for the perfect entry point, you may sit in cash for months or years. Meanwhile, the market grows. Compounding doesn't start until you're invested. Time in the market is more important than timing the market. That's not a slogan, it's mathematics. The earlier your money starts compounding, the more powerful the long-term effect. Here's your action plan. Step 1. Decide how much you can invest monthly, even if it's $50 or $100. Step 2. Set up automatic contributions through your brokerage or IRA. Step 3. Choose a diversified, low-cost fund. Step 4. Leave it alone. Avoid checking daily movements. Avoid reacting to headlines. Stick to the plan. Market downturns will happen. That's normal. In fact, downturns become opportunities when you invest consistently, because your fixed amount buys more shares at lower prices. Consistency turns volatility into an advantage. Trying to predict the market turns volatility into fear. Wealth building is not about being right at the perfect moment. It's about showing up regularly. And the investors who win long-term aren't the ones who made one brilliant move. They're the ones who stayed consistent for decades. In the next lesson, we'll talk about why your investment choices should always match your goals, not your emotions. Have you ever bought an investment and then realized you didn't actually know why you bought it? Lesson number 8 from How to Invest $50 $5,000 is this. Allocate your money based on goals, not emotions. Most investing mistakes don't happen because people lack intelligence. They happen because decisions are driven by fear, excitement, or urgency. The market goes up, people feel greedy. The market drops, people feel scared. A stock trends online, people feel pressure. And emotion becomes the strategy. Nancy Dunan emphasizes something much more practical. Every dollar you invest should have a defined purpose. Before you invest, ask 3 simple questions. What is this money for? When will I need it? How much risk can I tolerate? Let's break this down. If the money is for a short-term goal, like a home down payment in 2 years, it should not be in volatile stocks, even if the market looks strong. If the money is for retirement 25 years away, short-term market drops shouldn't scare you out of equities. Time horizon determines risk tolerance, but most people reverse the order. They choose an investment first, then try to justify it later. That's backwards. Your goal should determine your allocation, not the latest market trend. Here's a practical way to apply this. Step 1. Write down your financial goals. Be specific. Retirement at 65. Buy a home in 5 years. Emergency reserve. Clarity reduces impulse. Step 2. Assign a timeline to each goal. Step 3. Match the investment type to that timeline. Short-term money stays conservative. Savings accounts, CDs, short-term bonds. Medium-term money can include balanced funds. Long-term money can include diversified stock index funds. When your allocation is aligned with your goal, volatility becomes easier to tolerate because you understand the purpose. Another key point, avoid changing your allocation based on headlines. Markets move daily. Your goals usually don't. If your long-term objective hasn't changed, your strategy probably shouldn't either. That's discipline. It's also stability. One more important habit, review your portfolio 2 to 4 times per year, not weekly. Frequent monitoring increases emotional reactions. Infrequent, structured reviews promote rational decisions. Investing success isn't about predicting the next trend. It's about aligning your money with your life. When your investments reflect your real objectives, you stop chasing performance and start building progress. Because clarity eliminates panic, and intention replaces impulse. In the next lesson, we'll talk about how to handle unexpected large sums of money and why slowing down is often the smartest move you can make. What would you do if $10,000 suddenly hit your bank account tomorrow? Bonus, inheritance, tax refund, settlement. Sounds exciting, right? But here's the truth. Sudden money is often lost faster than slowly earned money. Lesson number 9 from How to Invest $50 $5,000 is this. When you receive a windfall, slow down before you make any decisions. Most financial mistakes don't happen because of small monthly investing. They happen when emotions are high and the amount is large. Sudden money creates urgency. You feel pressure to invest it quickly, or upgrade your lifestyle, or make it grow fast. Nancy Dunham emphasizes the opposite approach. Pause first. The first move after receiving a windfall should not be investing. It should be parking the money safely and giving yourself time to think. Put it in a high-yield savings account or insured money market account for 30 to 60 days. Create distance between emotion and action. Because money made slowly builds discipline, money received suddenly tests it. Now let's talk about priorities. Before investing a windfall, ask, do I have high-interest debt? Is my emergency fund fully built? Are there upcoming financial obligations? Paying off a 20% credit card balance is a guaranteed 20% return. That's better than most investments. Strengthening your emergency fund increases stability. Only after those foundations are solid should you consider investing. And when you do invest, avoid putting the entire amount into the market at once. Large lump sum investing increases emotional risk. If the market drops shortly after you invest everything, regret can trigger panic. Instead, consider spreading the investment over several months. This reduces timing pressure and keeps your strategy consistent. Another important point, avoid permanent lifestyle inflation. A windfall feels like extra money, but increasing fixed expenses, like car payments or housing upgrades, creates long-term obligations. Windfalls should improve financial security, not increase monthly stress. And don't ignore taxes. Some windfalls are taxable. Before making big decisions, understand the after-tax amount you actually keep. Here's your action plan. Step 1. Pause and park the money safely. Step 2. Eliminate high-interest debt. Step 3. Strengthen your financial base. Step 4. Invest gradually and strategically. A windfall is not a shortcut to wealth. It's a test of behavior. Handled wisely, it accelerates progress. Handled emotionally, it disappears. Wealth is not built by how much money arrives at once. It's built by how consistently and intelligently you manage it. In the final lesson, we'll talk about the most overlooked factor in investing success, your behavior, and why discipline matters more than intelligence. Let me ask you a serious question. Do you think investing success is about intelligence or behavior? Because lesson number 10 from How to Invest $50 $5,000 makes something very clear. Long-term wealth is built on discipline, not brilliance. Most people assume successful investors are smarter, that they understand complex charts, predict recessions, or know something others don't. But in reality, the biggest difference between successful and unsuccessful investors is emotional control. Markets go up, markets go down. News headlines create fear. Social media creates hype. And every one of those moments tempts you to act. Sell when prices drop. Buy when prices spike. Change strategies every 6 months. But constant reaction destroys compounding. Nancy Dunham's message throughout the book is consistent. The tools matter, but behavior matters more. You can choose low-cost index funds. You can diversify. You can use tax-advantaged accounts. But if you panic during downturns or chase trends during rallies, none of that structure will save you. The market rewards patience. Here's what discipline looks like in practice. First, you invest consistently, even when headlines are negative. Second, you review your portfolio on a schedule, not emotionally. Maybe quarterly, maybe twice a year, not daily. Third, you accept volatility as normal. Market declines are not failures. They are part of long-term investing. Historically, markets have recovered from recessions, crashes, and uncertainty but only investors who stayed invested benefited from that recovery. Another key habit: avoid over-monitoring. The more often you check your portfolio, the more likely you are to react to short-term noise. Short-term noise creates long-term mistakes. Wealth building is slow, it's rarely exciting, and that's actually a good sign. If your strategy constantly feels dramatic, it's probably unstable. Here's your action plan. Step 1. Define your investment strategy clearly: asset allocation, contribution amount, and long-term goal. Step 2. Automate contributions wherever possible. Step 3. Set a calendar reminder to review your investments 2 to 4 times per year. Step 4. During market downturns, remind yourself why you invested in the first place.